By the end of this section, you will understand what are the 5 major US fundamental indicators. You will understand how GDP affects a country's currency. You will understand the importance of balance of trade in Forex. And you will learn about the importance of the Philly Fed Index. Now, here are the 5 major US fundamental indicators. We have gross domestic product, non-farm payrolls, balance of trade, Treasury International Capital Survey, otherwise called TICS, and we have the Philly Fed Survey, also called the Philly Fed Index. Now, each of these indicators gives us insight into the state of the US economy. When they are combined, they give us an overall view of the US economy and as a result, help us to identify the future direction of the US dollar. And remember, the primary driver of market sentiment is interest rate. So all the economic data that is disclosed is used as an indicator to assess the likelihood of the central bank raising or lowering interest rates. Okay? So always remember, the primary driver of market sentiment is interest rate. How likely is the central bank to raise or decrease interest rate? If we have good GDP, good non-farm payrolls, and economy is going good, then we can expect the central bank to increase interest rate. And whenever the central bank increases interest rate, the currency of that central bank will rise. And this is simply because investors will invest in a country that is increasing interest rate because they will get more return on their investments. Okay, it's simply because of the transfer of money from countries that are decreasing interest rate to a country that is increasing interest rate. So that's the main reason why whenever a central bank increases its interest rate, the currency of that central bank increases in value. So always remember that interest rates are the primary driver of market sentiment.